Greetings, everybody. Welcome to Liberty Call. Today is Monday, October 9th, 2023. Hope everybody's having a fantastical day out there in the interwebs. Apologize for being a little bit late. I've had meetings all afternoon, so I'm having to shove this one in and before my next one coming up, I guess in about an hour and a half. So, all right. Hope everyone had a fantastical weekend. Kind of if you're an Astros fan, they played well on Saturday and put up a crappy game yesterday. So, anyways, and you can see I got a little bump on my forehead. I was winterizing the fifth wheel yesterday and bonked my head underneath the storage compartment. So anyways, all right. If it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me one favor and one favor only, hit that like button and the subscribe button and the follows and all that good stuff. So, and hit the notification bell because you want to know when I go live. Let's go ahead and get into the numbers for today. Dow Jones was up. Spent the morning down. It was up 0.59%, 197 points, closed at 33,604. The S&P 500 was up 0.63%, closed at 4335. The NASDAQ was up 0.39%, closed at 13,484. The VIX is currently holding at 1770. It probably it was down. It was in the 18s yesterday or Friday. Canada up 0.57. Brazil up 0.86. In Europe, I'm sorry. Where was I? Where'd I go? All right. Europe, they were down Germany was down 0.67%. The UK was down 0.03%. France was down 0.55%. Netherlands was down 0.1%. Spain down 0.91%. Italy down 0.46%. Switzerland down 0.14%. And Portugal was up 0.93% today. Russian exchanges both green. The MOX up 0.93%. The RTSI up 2%. And the overnights, looks like the Nikkei was closed. So Australia was up 0.23%. New Zealand was down 0.87%. In Shanghai, China, the Shanghai was down 0.44%. The Shenzhen component down 0.03%. China A50 down 0.69%. DJ Shanghai down 0.44%. Hang Seng up 0.6%. And the Taiwan weighted was closed. All right. So it looks like the rest of the world did not get the memo that the American markets were going to be up. Probably had a lot to do with what's going on over in Israel. Everyone's probably super excited, hoping their military industrial complex stocks are going to go up in value. Actually, on the TV earlier today, a bunch of them jumped like 6-8%. So I guess if you're a defense contractor, your wallet's looking better today. All right, let's get to the weekly economic update. A Friday rally overcame a shaky week, sending stocks mostly higher. The Dow only slipped 0.3%. The S&P 500 gained 0.48%, and NASDAQ added 1.6%. Overseas markets fell 2.37%. The Friday rally. Stocks rallied on Friday after a stronger employment report than Wall Street expected. The headline increase in September payrolls initially generated fears of further Fed rate hikes, leading to a spike in bond yields and steep early morning losses. A yield retreat may have triggered the turnaround as investors focused more on the month's moderate wage growth. Stocks were shaky much of last week on rising bond yields when Treasury yields hit their highest level since 2007 on Tuesday. Stock prices dropped, leaving the Dow Industrials in negative territory for the year. The catalyst for the day's spike in interest rates was surprisingly strong JOLTS report, the Job Openings and Labor Turnover Survey, showing nearly 1 million more jobs than investors had expected. The labor markets remains resilient. August JOLTS showed a job openings exceeding 9.6 million, above the consensus estimate of 8.8 million. A weak automated data processing, or ADP, private payroll jobs report released on Wednesday showed that 89,000 new private sector jobs appeared to be an outlier compared to the other reports. Friday's monthly employment report showed a robust gain of 336,000 new jobs, nearly double the consensus forecast of 170. At the same time, the previous 2 months saw significant upward revisions of 119,000 combined from initial reports. Wage gains rose modestly, coming in below expectations, and striking a hopeful note on inflation. All right, economic data this week. On Wednesday, we have the Producer Price Index and the Federal Open Market Committee minutes. Thursday, we have the Consumer Price Index and jobless claims, and Friday, consumer sentiment. Companies reporting earnings this week. Thursday, we have Delta Airlines, and on Friday, we have a bunch. JP Morgan, JP Morgan Chase, United Health Group, Citigroup, Wells Fargo, PNC Financial, and BlackRock. All right, so that is the weekly update. Let's turn our attention to the market recap. S&P 500 cuts losses despite rising geopolitical tensions amid Israel-Hamas war. The war drums are beaten. All right. The S&P 500 rebounded on Monday despite rising geopolitical tensions associated with the Israel-Hamas conflict, which raised concerns about the potential for a broader conflict in the Middle East. The surprise attack by Hamas on Israel and Israel's subsequent declaration of war dominated investor attention, briefly dampening risk appetite. Amid the conflict, Chevron Corporation saw a more than 3% rise after the Israeli government ordered the shutdown of natural gas production at the Tamar platform in the Mediterranean for safety reasons. The move contributed to a higher performance in energy stocks, supported by concerns of potential disruptions in the oil-rich Middle East due to escalating geopolitical tensions. Key players in the energy sector, such as Halliburton, Marathon, and Hess, experienced notable gains. However, U.S. airlines, including Delta, United, and American, witnessed declines after canceling flights to Israel. The cancellations were attributed to the heightened risks associated with operating flights in a region experiencing warfare. Intel faced marginal losses as concerns arose that the Israel-Gaza conflict would impact the chipmaker's plans to build a new chip-making plant in Israel. Intel had previously committed to investing about $25 billion in constructing the new chip factory, scheduled to open by 2027. NVIDIA Corporation canceled its AI summit scheduled for October 15th and 16th in Tel Aviv, Israel, reflecting the disruption caused by the ongoing conflict. Tesla traded slightly lower as data from the Chinese Passenger Car Association indicated a 10.9% decline in the company's sales in China in September compared to the same period the previous year. In contrast, Chinese electric vehicle maker BYD Co. Experienced a significant sales increase of 42.8% to 286,903 units in the same month. All right, so the world's falling apart. Everybody's freaking out, and these morons want to go to war again. Nothing good can come from this. All right. Last article here comes from our friends over at First Trust, Mr. Brian Westbury. This one's titled Crisis Management Government Leads to No Good. All right. The article critiques the monetary and fiscal policies implemented during the 2008 financial crisis and more recently in response to the COVID-19 pandemic. It argues that these policies, primarily massive government spending and monetary easing, have had detrimental effects on the economy. And I would argue that they weren't necessary at all. In 2008, the government under Ben Bernanke and Hank Paulson enacted policies such as the $700 billion bank bailout, called TARP, and allowed the Federal Reserve to pay banks interest on reserves. These measures were intended to address the financial collapse, but the article contends that they were damaging. It suggests that the 2008 financial panic could have been mitigated by changing mark-to-market accounting. Instead, the subsequent implementation of TARP and quantitative easing led to a further 40% drop in the S&P 500. The panic only subsided when the mark-to-market accounting rules were adjusted in March of 2009. The article also criticizes the prevailing belief that crises necessitate massive spending and money printing, while acknowledging the initial fear of the pandemic during COVID-19. It argues that by the end of 2020, data showed government shutdowns were causing harm to education, small business, and supply chains, as well as contributing to inflation, which is our biggest problem now. Despite this, government spending and money printing continued into 2021 and 2022. Instead of returning spending to pre-crisis levels, it increased. The article notes the significant rise in non-defense federal spending as a percentage of GDP, reaching 24.5% from 2020 to 2023, compared to 15.3% from 2007 to 2009. The article also questions the effectiveness of Keynesian economics, asserting that the government spending doesn't lead to sustained economic growth. It points out that potential real GDP growth has declined from roughly 3.5% in the 1980s and 90s to an estimated 1.5% today. Moreover, it criticizes the monetary policy mess created by quantitative easing, resulting in an $8 trillion Federal Reserve balance sheet. This policy forced banks to hold more deposits and assets, potentially making them vulnerable if forced to mark their assets to market. The article also raises concerns about the strange developments, such as the Treasury General Accounting holding $679 billion at the Federal Reserve. It questions the necessity of such a large account, which costs Americans $34 billion a year in interest payments. In conclusion, the article advocates for the reversal of these policies, asserting that the cost of big government continues to rise and needs to be addressed. I think we say that every week, that big government is the bane of all of our problems. But unfortunately, you got to fire all those worthless parasites, and they're the ones who have a say in the matter, unfortunately. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.